So let's continue where we left off. The first session is uploaded onto YouTube. We'll get rolling. So who trades foreign exchange? Now, obviously the banks, but the foreign exchange market being the largest market in the world in magnitude by far, 600 to 1, just a massive behemoth of a market. Everything that transacts or moves cross borders, whether it's import export deals, investments, money market instruments, banking operations, obviously, energy supplies, interest rates, they all have an effect on foreign exchange or help create the demand for foreign exchange transactions. But each participant has their own objective, whether it's a government, a bank, insurance company, import exporters themselves. They're typically one-sided. They're doing a transaction today, but not at a really high frequency of transactions. It's when their deals are done, especially for a small enterprise. Now, a large international corporation will do transactions and have foreign exchange desks themselves, right? Then you see the travelers or the retail speculators. Travelers less frequent than the retail speculators, obviously. But all of these are the participants. And as a retail trader, that means you're exposed to all sorts of information that typically you would not have access to. So it's important, if we just glance really quick into this, who can we observe in this list of governments, banks, and insurance companies, maybe hedge funds? Those are the dominant side of this market. So then, out of the who as participants, when it comes to volume, as I deviate away from the discussion briefly, I think it's necessary. When it comes to volume, if we're looking at the flow of movement and we can recognize either bullish or bearish intent, and we see that differential between a perceived value and an actual price or the rate, well, we know that is, at least if it's covering the cost of doing business, that perceived value and rate are telling us where that volume is coming from. Without that identification or that data point of the perception of what the institutions are looking at, there's very little mechanism for any sort of transparency. But if you understand that, being the perception and the rate, you then know that that is what's going to trigger volume. We also know that it's the banks, hedge funds, insurance companies, and governments, including central banks. They're the ones that are the dominant side of the market. So if you know, again, in review, if you know the perception of value, which is the immediate price level that a bank expects, that's the directional influence. The difference between the perception and rate is the aggression that entices volume. You know who's creating that volume because you know who the participants are. And that keeps you better than 50% of all movements. Just with that alone, you'll be on the strongest side of the movements, better than 50%. After all, that's the dominant side of the market. And at times that's 55%, 60, 70% in strong moves. And that's why moves become strong in themselves. But yesterday, I posted some commentary on order blocks. And if we talk about order blocks specifically, and I want to because we're talking about volume and the dominant side, the theory behind order blocks is that there's large orders that are sitting there. That's actually not the case. While it could be a possibility of large orders sitting there, banks trade 95% of their daily volume as speculators. 5% as market making. And by the way, I digress because I just posted a video on TikTok on market making. It might be truly insightful for this, but only 5% is market making. So if a market has gone range bound, where retail thinks that there's order blocks there, it's actually the smallest slice of the overall day. But what isn't there is a perception of value, either higher or lower. It's a stagnant market. That perception of value for the banks, which are the aggressive parties that cause the market to move, has gone nowhere. So the market sits there. Very rarely, and let's put order blocks into perspective. Order blocks are supply and demand. Supply and demand are support and resistance. Support and resistance are supply and demand. Supply and demand are order blocks, and support and resistance are order blocks. They're all the same thing. As I said in one of the other posts, it's the same old can of beans. Just got a different label on it. But those cans of beans are no different than one another. What all of them lack is that perception of value. So when a perception of value starts to show a bank that they can generate more, all the banks are doing is looking at the same thing or relatively close. They each have their own mechanism of determining value, and that's what the quants have provided them. Right? But they don't have the benefit of leverage. So now we can go back to leverage and put it into perspective, because not only do we have the same level of information, but we've got the very tool that the banks are using against you, or the brokers are using against you in leverage, but yet we have the intelligence of what they're doing. It's really a no-brainer. You want to be on the strongest side of the market. You have to have that perception of value, and if you don't, forget it. You might as well quit. Now, I can, tell you how, the markets move with this, and I can allow you to use, the tools that we build. But somebody or a couple people have asked me over the last, day or two, what is the calculation? I won't tell you the calculation. You can't afford to pay me enough for the calculation, because that's my entire career. But in building models that give you the transparency, if that helps you and eliminates the risk of your trading, by all means, use it. By all means, use it. So in order to break outside of this range, you want to know what better than 50% of the market participants are doing. And you want to know that it's the aggressive side of that 50%, better than 50%. But all of this range-bound nonsense, order block, supply and demand, support and resistance, if there's no differential in value, the price is not going to go anywhere. And that could be completely in the middle of nowhere. Foreign exchange rates trade in ranges, and then they break outside of those ranges when there's a perception of value that is different. And when they break outside of those ranges, they go to new levels. So it all comes down to something more like this. That's it. Ranges, breaks outside, it goes to a new level, goes in back into a range, goes to new level. But that's because in here, there's no difference between value and the exchange rate. And then here, the value dropped lower and the exchange rate lagged behind. And when the difference between the rate and the value, or the value and the rate, is significant enough to entice aggression, that naturally causes the sell-off all the way down here until the value goes range bound and the rate follows it range bound because there's no longer a differential in value. That remains until the value then sees an increase. The rate follows because the bankers can see that there's a free yield in between the value and the rate. They start aggressively buying, and that happens until it goes back into a range bound move. That is everything. But yet the retail sector has been misled. Their vision of analysis has been contorted into something that it's actually not. You know, and some people make comments, and there's a lot of trolls anyway in the industry, but some people make comments that say, well, price action works. Yeah, it could have worked a couple weeks ago when the market was moving really fluidly and there was a bullish run on all the cryptos. Not that the cryptos are going to drive the market, but that's just the ideal scenario for price action traders. Is an entirely bullish or completely bearish market either way. But when it goes range bound and you're not certain, we got caught in a little bit of range bound move the other day, I think on Friday, and then it broke outside of that and it gave a reversal, and then it came back to where I expected it to go the first time. But foreign exchange trades in ranges. It breaks outside of those ranges and goes to new levels until it goes back into the range, and then it breaks out again. It can go any direction, but that's the process. So let's continue a little bit. The hours, I don't think we need to cover. You know, the ideal hours for everybody are going to be the same. Yes, it is a 24-hour market, but London open to New York, London overlap around 8 a.m. Eastern until about 12 p.m. Why? Because daily distribution. Daily distribution does this. If this is Asia Pac and this is Europe, this is the London, New York overlap, right? There's a little bit of London lunch. There's a little bit of a pocket there or a slowdown, and then London is technically still in business for the day. The overlap starts here, and that increases volume. So, you know, the daily activity and the resulting volume. But this is the geographical sector kind of broken down. New York by far has the largest. The combination of the Eurozone and New York by far the most significant, from about 7 a.m. Eastern, 8 a.m. Eastern, till about 11 a.m. Eastern is the majority. And we know for certain that between 8 and 9 a.m., you have about 8% of daily volume in that 1 hour. Between 9 and, 6% in that hour. 8% between 9 and 10 a.m. and 17% between 10 and 11 a.m. That is because the Londoners are now just about done with their day. They're finished with their operations, but we're in the heart of the New York trading day. So 17% within that 10 to 11 a.m. hour. And you've got another 17% within that 8 to 10 a.m. hours, those 2 hours. So that's 34% of the daily trading volume in that 3-hour period. You've got to pay attention to that. Because if you're trading those other hours, just like a news release, news releases are volatile because there's no liquidity. The volume is not there. Oh, let's go back and do a review. Same thing that's happening in those range-bound moves where retail thinks that there's order blocks there. It's actually just no value discrepancy between value and price. And it's a quiet market because there's no liquidity. It is not heavy orders. Heavy orders are just the outliers. whether it's to the downside or the upside, whether it's on the bid or the ask. The heavy orders are up here, but all of this other stuff is nonsense. But even as it gets to these highs or these lows, it still has to have a perceived value that is much higher to break it outside of that range. So if you're trading in those off hours, just like a news release, there is no liquidity. You're going to get abstract movement. You're not going to see that fine-tuned movement or reaction to the market in sentiment the way you would want to in an ideal situation. It's going to be a little bit more hit or miss. But focus on that London Open to, again, the New York London overlap up until about midday New York, where you're going to get those heavier hours. If there's no major news releases, you might get some drift, but if there's even some bias to direction, whether it's bullish or bearish, you'll get some solid follow through. But that's just kind of the limitation to fundamental, expectations or news releases, which are a little bit more defining as in terms of timing. They can certainly be dramatic, but in terms of trading hours, focus on that London Open to the New York overlap. Bid-ask spread, right? We already talked a little bit earlier this morning on what the bid and ask spread is in terms of the mousetrap, right? Mousetrap being, okay, 32 bid and a 33 asking price. As a retail trader, if you're going to buy, retail is forced to buy at the 33, and you're forced to sell at the 32, and that allows the market maker to make money, right? That's where their revenue comes from. But yet, when you get to an institutional venue, say an ECN, a CurrentX, a Knight Capital, Hotspot, EBS, Reuters, well, then you can make the market at a 32 bid and have the best bid on the book. And the first person that sells to you is going to give you the entry. So you've bought it at the lower price. You then cross market, you go over to the asking price, you lay an asking price, somebody buys it from you. What you've done is you've taken the sale, you've taken the buy on the sell, and you've sold it on somebody else's buy. You've made the market in the middle. Now, a quick experience, or the first example, when I built the first time I turned on a multi-ECN arbitrage platform, which is the one I built for volume-based identification of statistical arbitrage. It was meant to be a high horsepower machine that would connect multiple liquidity streams and trade instantly when it recognized an arbitrage opportunity. The first time I turned it on during a news release, in less than 3 milliseconds, it made $855 because it recognized two different arbitrage trades on 3 different networks, and it was instant. It was instant, but then it still needed that volume, dissection and that computation of what volume was doing to make it more resilient, right? So the bid-ask spread for us and for you, it's important because you can get some information from that. You've got to watch on what you're paying. In other words, the cost is probably the most significant. And if you're with a broker that charges, 0.6 of a pip, I would run really fast. If you're with a broker that charges 0.2 of a pip on their spread, that's pretty fair. But again, that's just the entry. What is the exit doing? Because obviously, if you've got 0.2, this is your cost. If that's your entry, you still have to pay the 0.2 on the exit. But what if they're skewing your price? In the previous session, we talked about that. If they're skewing your price and really giving you a net all-in cost on the spread because of slippage of 0.6, right? Well, that becomes significantly higher. So the bid-ask spread is important, but just as important is the efficiency of the execution, right? But to lay out the definition of it, a bid is the price at which you would sell at. The bank buys, or the brokers, right? An asking price is the price at which you would buy at, or the brokers and banks sell. So it's the opposite. It's a mousetrap. You are forced, as a retail trader, you are forced to buy the ask, sell the bid, provide the broker revenue, provide the bank a stream of income, and this does something else for you. In terms of limit orders, it assures you that you're in a mousetrap. But also, if your intent was to sell at the 32, I just happen to use 32 because it's a favorite number. If your intent was to sell at the 32, but the price only gets to a low bid of, let's say, 32.2, you'll never sell. Or you'll never sell being the bank won't buy it from you, right? If that price only gets to a 32.2. The price has to drop to that 32 for you to sell. In other words, a limit order, which are absolutely fine in the most frequently type of order, a limit order for you to place a sell at the 32, they're not going to buy it from you until the price drops to 32. Right? So they want that diversion. They want that deflection. They want that income. Now, this is with a limit order. You can sell at a market order at 32. But a limit order is going to be different because the brokers don't allow that inside movement. So if this is the 32 and this is a 33, you can't place on a mousetrap broker, MetaTrader 4, you can't place a limit order inside here. In fact, you can't even place really a limit order. Because if you want to buy the 33, you can do that. But how do you buy at the 32.5? You can place the order at 32.5, but that's not truly a limit order. What it becomes is a market order. And we're going to talk about orders a little bit later, but this becomes a market order when the bid is 31.5 approximately, and the asking price is a 32.5. So you're still forced to pay the spread no matter what you do. And you've got to take that into consideration. I hope that was clear. Let's move forward. Bullish and bearish markets, I don't really need to explain too much, I don't think. The difference between them, and I'll give you the historical definition. A bullish market is when you put a bull into a fighting stance, the bull is going to get down on his front legs and then push the market higher. That's historically what it is. But a bear is going to get up on his hind legs and pull the market lower. Here it is. That's it. So a bullish and bearish market are just bullish and bearish moves. This doesn't take into consideration any time frames. It doesn't take into consideration any trends. There's all sorts of other stuff. There could be fundamental analysis. There could be the technical side of things, which we don't talk too much about. We want to kind of stay away from the technical side of things. But what we want to do is study right now. What is happening right now to the candle, and how is that different? And as a result of the value, we'll see what the candle is doing. If we don't have the perceived value at our disposal, we still have to understand kind of the microstructure of what that candle is doing. The bullish and bearish market just gives us kind of overreaching sentiment, if you will, just a feeling of where the market's heading. What happens in a bullish and bearish market? It can be all sorts of different answers here, depending on what's triggering the news. All right. So if it's news related, if it's just macroeconomic related and not necessarily news, if it's interest rate related, maybe it's, political related, maybe it's, conflict related. There could be all sorts of different variables that would affect what happens inside a bullish market or what's triggering that bullish market. Leverage. Here's kind of that key discussion again. Foreign exchange obviously provides one of the highest amounts of leverage out of all the markets, by far, out of all, right? But it means having that ability to control a larger position or an investment vehicle or a trade position sizing for an amount of capital significantly less than what the position is. And I've got an example there. You can stop this video if you're watching it and go over that. But more important to this, in terms of leverage, is who is providing you the leverage? Why are they providing you the leverage? Well, the answer is pretty obvious for the who. It's the brokers. They want you to trade higher amounts of volume. And leverage allows that gearing, the mechanism of additional credit, which you could typically not trade in, say, the equities markets, or even a little bit more limited in the futures market, more limited than foreign exchange, but greater leverage in the futures in comparison to the equities. But they're offering you the leverage because they know that you're not going to trade well, and you don't know the real reason behind exchange rate movement. And we're talking specifically with foreign exchange here. So the who is obviously the broker. The why is for profit. Whose profit? Theirs. Their profit. For foreign exchange, because 98% of brokers are only B-book brokers, that means they're internally maintaining or holding or inventorying your risk. So when you buy, they have sold to you and they maintain that position. When you sell, they bought from you, maintaining that position internally. So dollar for dollar, with the exception of commission and spread, dollar for dollar, everything that you lose goes to them. Anything you gain comes from them. But again, you don't have the transparency at your disposal to know precisely how, why, and when the banks are going to become aggressive, because you're stuck looking at price action. You're stuck looking at the charts. You're stuck in this range, or you're not looking at value. So you don't really have a whole lot of insight into the direction, let alone when it's going to break outside of that direction. But leverage is a powerful tool for everyone, especially if you're aligning your trading, your insight, the value, that perception of value, the price response, whether it's volume based or literally that perceived value. And somebody asked me this morning, maybe last night, where does the data feed come from? It's all on your platform. But as I said in the earlier session, you've just never been told how to dissect it. You've never been told how to gain insight into the direction of the euro dollar because you've been stuck on everything else. You've been stuck on the charts, and the charts have stolen from you. So leverage. It can work for you or against you depending on how intelligent you are and how much transparency. Margin is just a component of leverage. It's the actual amount of money that you're committing as a good faith deposit to open that position, which is a leveraged position. Right? So consider the leverage example. Take a position of 100,000 with an initial deposit amount or good faith margin maintenance on your account of 1,000. 100-to-1 leverage would give you the 100,000. Right? That is the margin deposit. So there's a slight difference between the margin and the leverage. Stop losses. So when you take a position, and I think everybody probably knows this. If you don't, it's really simple. You take a position recognizing that the price has broken outside of that range and you've gone short right here. In other words, you've sold, right, in a bearish market. If you've got a stop loss, the stop loss would be placed with the broker, sometimes placed with the broker, sometimes manually observed. But that should be your rule based on the approach that you have, based on the analysis that you're utilizing, based upon the leverage that you're using and the risk to reward ratio. I don't typically talk about a risk to reward ratio because those tend to be static. But a static measure is not what we want in a dynamic approach. But the stop loss would be a protective measure outside of that range of acceptable movement. And if the price has reached that stop loss, that should take you out of the trade. So while you enter short, you can predetermine or pre-identify that level of stop loss. Or when it reaches that level, you can manually close the position knowing that it has, in fact, breached against you and decided to climb all the way through that prior high, even though you were using a static level of analysis trying to predict, and you thought the price was going to come down here, but it reversed against you right here. And even though it reversed, you still kept that static level of take profit. It never went to your take profit and finally hit your stop loss. You're done. You're out. You're done. You're cooked. That's the process. So, but the stop loss should be protective for you, right? And they are important. Manually, once in a while, I'll get into a situation where I should have taken a stop or should have executed, should have closed the trade out, but I have those weak spots too. Stop losses in a very high frequency approach tend to be a little bit better because we humans, we like to judge or rejudge or reanalyze and then deteriorate our approach because we fail to heed that static measure, that slight static measure of where that stop loss is, and we tend to second guess our impulsive movement. Not gonna go. Okay, so hedging. Hedging is just the mechanism as we go through this. I would not suggest hedging so much here, but hedging is important because you can. I did it on Friday. I hedged the position that I was in until the market came back my way, and then I took those hedges off. But not something that I would suggest initially, certainly at an entry level of skill sets, not something you would want to complicate because hedging does increase your cost. You're going to pay double the spread, double the commissions, and double the risk in terms of slippage if there is. But we can go into hedging just a touch. you're either going to open a position in an offsetting instrument. In other words, if you're long euro dollar, or in this case, crude oil, it talks about, you can go short that instrument as well, right? You can also go to a related instrument. In other words, in the spot market, you can go long the spot and short the future to hedge your exposure. Now, what you will find is that the carry charge on futures, and I don't want to go too deep into it, but the difference between spot market and a futures will have a carry charge, which is an interest rate component that is added to or subtracted from the price based upon the differentials between interest rates in the countries, if you're talking about foreign exchange futures. So foreign exchange futures can be used to completely offset the spot market position. So if you go long spot euro futures or euro dollar, you can go short the nearest future. That's it. That's a hedge. But yet you're going to have the interest rate component that is going to have a slight effect, depending on how long you have this hedge position open. It'll have a slight effect, maybe a pip or two, on your position if you hold it for a few days, right? But you can either hedge in the same instrument or in a related instrument, basically the same item in a different market. Spot to futures, futures to spot, option. There was one point in 1996, and I think I'd mentioned the other day in kind of the backstory, that where I was trading the Philadelphia Stock Exchange currency options at the time. And I owned 87% of the open interest on the Swiss franc options. Well, that was because there was only 13 of them. The story sounds better until I give you the details that there was some less than 20 number. So while I owned 87%, there wasn't that many of them. But what I was doing at the time is I was taking a position anytime that the spot price reached the strike price, the strike execution price of the option, I would go long, let's say 2 million. And then I would buy the put option for about 2.5 million in volume. In other words, I would buy enough put options that if the price went lower, not only would I recover the losses of the 2 million, but because the increased leverage of that extra 500,000, that would cover the cost of the option and I would generate a return. If the price continued to climb, I would only lose a time component on the option. And the option, because I bought it at the money, it wouldn't have a whole lot of intrinsic value. So it would have some deteriorating value because of the time, but also very slightly because of the position size and it being out of the money. But that allowed me to speculate with a fully hedged position on a fairly short period of time when a news release was going to occur. I did this for 6 days before the broker, the clearing broker that I was using, said they could not take any more trades for me because I took them to the cleaners. But that was using spot market options in the currencies and taking a position that was better than or larger than the actual spot position. So it took the option, it was a better position or a larger position than the spot market entry. And that hedge basically protected me with a really good efficiency that told the broker they should not be taking any more trades from me, because it didn't make a difference where the market went. I was going to make money. But at the same time, they were using a data feed, which was, I would say, 4 to 5 seconds behind my feed. Right. But that was the issue with data feeds a long time ago. If they were using a Reuters data feed, it would have been okay. But they were using, I believe, an e-signal data feed, which was garbage, and it still is garbage, or at least it has been up for the last few years. I don't know if they're even still around. But at the time, they were using an e-signal feed, which was completely different from what my feed was. All right. That's hedging. That's a good example of it. Types of foreign exchange markets. Obviously, there's the spot market. There's the forward market. There's futures market. Futures we just kind of touched on. There's an interest rate carry charge for the futures contract. And each of those expirations of the futures, whether it's a December, February, July, August, the different expirations will have a different amount of interest that's added to the futures. So you can have the near future, which will closely resemble the spot market, but the near future will follow the spot market, and this will include the carry charge. Then you have the forward market, and the forward market is a deep, deep, deep mechanism. Banks use the forward markets typically, and the forward market is good because you don't suffer the exchange rate fluctuations as much, because what you're doing is transacting for today at a predetermined date. So while the futures markets will see more fluctuation because of the price fluctuation, profit or loss, what the forward market is doing is committing you to today and the transaction today plus or minus points. So it's a little bit of a different mechanism. It's kind of like using the spot market with a future delivery date, but without the exposure. The only difference is how much you're going to pay by committing to that forward rate, right? So we're not going to go too far into it. Where we focus is the spot market, and everything else as a direct result of the spot market. So futures market is related. You can trade the futures on our perceived value of sentiment, and you'll do quite well with it. Option market, I'm not talking about the binary options. I'm talking about the spot market options that you can go to a bank and get. At the time, I was using Union Bank and Smith Barney for the currency options back in 96, 97, somewhere around there with, 96, 97. So swaps market. Swaps market are effectively, they're related to the forwards where you're going to pay points on the swaps, but also your positions in the spot market are going to have swap fees added to it, because that's the difference between the interest rates and effectively what becomes a carry charge for you to hold that trade from today until Wednesday, until Thursday. The differential between interest rates on that position size. So if the Eurozone has got 5% and the US has got 2%, there's a differential of 3%. Well, that 3% over the course of 365 days, so that total position sizing and the interest rate differential was going to be the swaps that you're going to pay. Now, there are swaps markets themselves in futures, obviously, and options. You can options on futures, options on spot, even get into recent years, the crypto space. We're going to focus everything that we do on the spot market, though. And here's all of that. Here's the forward market. Disadvantages of the forward market. We're not going to go through that stuff. We're going to focus on the spot market. Let's get down to trading systems. Trading systems are important because it will tell you where there's transparency and where there is not. Right? So it'll also tell you where you're in a mousetrap or where you're not, and where you're in a neutral environment or where you're not. Same thing. But institutional participants are trading on ECNs, electronic communication networks, ECNs. The ECNs provide a neutral environment. And a neutral environment allows you to place limit orders and become a market maker, generate the spread. Now, in the futures, you can do this. I'm not sure if you can do this in the prop fund futures, but in the futures market, you can. You can place a bid and place an asking price. And in whippy moments, if you slapped both of those, or what I call splash those markets with both a limit order bid and an offer, you're going to get taken out with a profit. It's just going to happen. So if you're watching the perception of value go range bound and it not really being sure, you can put your limit orders in the futures market not too far away, enough to cover your commissions, and you'll get taken out pretty quick and have a net profit. But ECNs are the transparent, those direct market access venues. The next level of venue would be the brokers. So there's a difference, though, between the ECNs and the brokers. And the brokers I'm talking about here are the retail brokers. The retail brokers, where you're forced to pay the asking price, you have to sell on the bid. The market maker is always generating a revenue. And this used to be, in spot market, a voice broker. I use Tullett in Tokyo. I use MW Marshall, Noonan Ashley, and Ashley Pierce. I've used all the voice brokers where you can hear on a voice stream, literally a squawk box. You can hear 25 bid, or 25 taken, paid, given, you name it, all the different terms that were similar to what happens in the trading pits, right? So the voice brokers were prominent until about 2000, and about 2000. There's still a couple of them left, but for deeper pocket traders, right? The value of the information that you can get from them is pretty significant, though, because if you hear 25 paid or given, well, paid being somebody paid the asking price for 25 million, or given being somebody sold 25 million at the bid, right? So there's some definitions in there that if you listen to a squawk box, if you've ever heard one, you can get some information as to who's buying and who's selling, because they will sometimes tell you those the broker IDs or the bank IDs at the same time. Direct dealing, another discussion. It's basically a prime broker. Now, prime broker will offer credit, whether it's a credit line or whether it's an asset-based line or a margin line, effectively leveraging up your margin to give you a total position size and credit that you can take. But the direct dealing becomes nice because as a trader, you have an account with a prime broker, and the prime broker says, I don't care where you trade. So then I can go to CurrentX and open up a profile with CurrentX. And I can go to Hotspot or Knight Capital, and open up an account with Knight. Or I can go to Integral or any other platform and open up an account with somebody that provided service to them. And then the prime broker, I'll use ABN or Rabobank as an example. The prime broker, if the prime broker is Rabobank and I go to Integral or Hotspot, they're going to extend the credit. because they know what my assets are. They know what my trading proficiency is. But they're going to extend the credit and allow me to buy over here. And when I buy over here, that's going to get lodged into my account off the credit. And if I sell over here, those two positions are cross-matched. They're netted out. Hotspot, I've not traded with anything at that point. But if CurrentX and Integral have an offsetting position, it all gets netted out inside that account, that custodial account with Rabobank. I can leave that account open with ABN. And if I decide to place a trade with somebody that ABN serves, or maybe I want to, place a trade with XYZ. Well, Rabobank, knowing that I have the credit extended with them, XYZ can reach out to Rabobank and do what's called a give up. So a give up is me placing a trade with XYZ and them switching the position so I can collect my profit. So now I'm giving up the trade directly with XYZ. Let them take it with Rabobank. Rabobank then places it in my account and nets it. So there's all sorts of mechanisms that direct dealing can give a benefit with. Let's continue. Matching systems. These are effectively the ECNs, right? Whether it's Hotspot, again, Hotspot, CurrentX, Reuters, Bloomberg, you name it, Integral, FXall. The matching engines provide the mechanism of direct market access, DMA, right? And that typically uses a fixed protocol messaging format where it's standardized amongst the majority of participants. A couple of them use some other formats which effectively unify fix anyway. So they're similar yet connected, or dissimilar yet connected, and therefore they're one and the same. So there's only a couple of different API protocols for the connectivity, but most commonly it's fixed protocol. And I think I talked about the fix engine that we use that would process over a couple 100,000 operations per second. And that was key for us. And I think I mentioned that in the backstory the other day. But the matching engines provide transparency. Your broker says they use an ECN. Well, some sad news for you. They're full of shit. Now, FXCM said that they were using an ECN. So for customers inside the US, when FXCM was promising that they were using an ECN, they in fact were not. And they were making a fraudulent statement, not just to the NFA and the CFTC, but all of their customers as well. So they were booted from the US. That's because they were making that representation that they're using an ECN. So the experience that I have with retail brokers, whether it was LQD or any of the others that I've talked to, FXCM included, so the experience I have is if they show on their website that they are an ECN, or they state that they are an ECN entity, or they're an ECN broker, first thing you do is trust them maybe a little bit, and then you verify it. But typically, and I would say 95% of the time, when you ask them about the ECN itself, they will tell you that they use a liquidity provider. But the liquidity provider is completely a B-book. So are they an ECN, or are they giving you a fraudulent statement to show you that they're an ECN, but in reality, they're using a B-book that is an entity that is related to them, that is paying them back, and they're misrepresenting the facts of it being an ECN? Because if it were an ECN, you would be able to make markets. But it's not an ECN. And it's really easy to see that it's not an ECN because you're forced again, to pay the ask and sell on the bid. And if it were an ECN, you would be able to sell on the ask. Yeah, you would be able to sell on the ask if it were an ECN, because you could place a limit order asking price and somebody else could come in and pay you for that asking price and you could make the revenue. But if your broker is telling you that they're an ECN broker, in 99.99% of the cases, they're full of shit. Sorry for being so blunt. It's just facts of the matter. But they're all B-book brokers, which brings us to a whole nother discussion, but we're not going to have that at this moment. We will, but just not at this moment. Let's get to the next slice here. So major currencies. This becomes relatively obvious. Relatively obvious. And I don't even think we need to discuss this too much. You know, just like when somebody asks me, Nick, can Flow Trader, your volume model, work in gold or anything else? And I say, yeah, sure. But why would you want to? You should want to trade where you're going to see the most market efficiency, the most liquidity, the lowest cost, the less slippage. You get into a currency pair that's got a wider spread, Norwegian krone, Danish krone, those, you know, that's going to increase your cost already because it's a wider spread. Yes, it might have more volatile movements, but you want to be consistent in your trading. And in order to be consistent in your trading, you should be trading in a market that gives you more transparency, which is the same answer that I give somebody when they say, can I use your volume model in gold? Yes, but why would you? You want to see that transparency. And as we've already discussed, foreign exchange is by far, in public's view, more complicated. But by far, with a view of transparency, it's the easiest to trade. And that's why it is the gold mine for banks. They make most of their money on foreign exchange transactions. Don't let anybody kid you, because it's an off-balance sheet transaction. They can just absorb money. They can suck it up like a vacuum cleaner. And that's how they do it. It's a pressure of vacuum that causes that price to move.